Hello guys, we are going to study today what are basically general principles that are applicable on auditors. So as an auditor, first of all, please remember that we always have to follow code of ethics. We have to be compliant all the time with the code of ethics, which is issued by International Federation of Accountants body, and ACCA has adopted this code of ethics as it is. We will also study it in detail in chapter number 3, in which we will study ethical threats as well, right? So, the first principle is that auditors have to be compliant with code of ethics. They have to behave ethically in all manners, in all things with the client, in all their dealings with the client. Okay. The second important thing is they have to apply professional judgment. So basically, as you know, that judgment always varies from person to person. This is subjective in nature. As an auditor, when we will check the records of the client, the information of the company that is prepared by the management of that client, in that information, the management has used a lot of judgments. And where do the judgments come into existence actually? So basically, if I talk about financial statements, whenever accounting standards do not give any clear guideline about the treatment of um, or you can say, if sometimes accounting standards give us flexibility or option, then management uses their judgment. So basically, let's say I-16 guides us or gives us the options to use straight line method or reducing balance method, but does not specify that when do we have to use straight line method specifically and when do we have to use reducing balance method specifically. So the management basically has used their judgment in order to decide, in order to set that which method they are using in their organization. So now the auditor will use their independent uh, professional judgment to assess that whether the judgment of the management is correct or not. So by professional judgment, it does mean that auditor's judgment should be independent. Independent means it should not be biased. It should be free from any influence. Also, this judgment should be experienced. Then the third principle on the auditors that is applicable is professional skepticism. Please remember that we have to follow always a questioning mindset. We will approach every single thing in AA with questioning mind. We have to perform our audit with negative thinking. We will think that there could be any fraud in the information that client has provided to us. And if there is some fraud, then how will we find that out? Okay, so basically, this is the principle that will save us in the court, that we can explain there that we have used our professional skepticism, we have obtained the evidence using professional skepticism, and that's why if we have given reasonable assurance, it means no one can challenge our reasonable assurance. Okay, then the fourth principle is follow ISAs. ISAs stands for International standards on auditing. So basically, ISAs are the instructions about how an audit should be performed, and we have to follow those instructions. Okay, we have to follow ISAs. We have to perform our audit following these ISAs. Okay, then the fourth principle is then the last principle is basically due to subjectivity. Subjectivity means judgment. So basically, the client will provide us financial statements that they have prepared, that the management of the client have prepared. As an auditor, what is my problem with their financial statements? My problem is in these financial statements, management has used a lot of their judgment. Okay, so with skeptical approach, I think that this judgment will be biased. Management's judgment will be biased. I think that where they see that their profit figure is, let's say, less than what they expect, they will manipulate their estimates in order to smooth their profit. For example, let me give you an example. Let's say the management of the client has decided to change the useful life of their plant and machinery from 15 to 20 years. So basically, does the standard allow them to do so? Yes, definitely. ICE 8 allows them. ICE 16 says that useful life of plant and machinery or any non-current asset should be reviewed at the end of at each reporting date. Okay, and if there is a genuine reason to increase the life, they can do so. But what do I think as an auditor? I think that they have increased, they have extended the useful life in order to decrease the depreciation expense so that their profit can increase. Okay, so as an auditor, I cannot stop them doing so. So can I say, when there are a lot of judgment based areas, for example, there is allowance for doubtful debts, there are provisions, there is depreciation. Okay, so they have used their judgment at a lot of places in financial statements. It means these estimate areas are basically gray areas in which there is a fair chance of manipulation from the side of the management. Okay, so this is the reason, because I doubt their judgment. And if they have used their judgment to manipulate the financial statements, it means I cannot give the guarantee on the financial statements. I'll not give absolute assurance on that. Okay, then the fourth reason is that evidence that we always found is could be persuasive but not conclusive. What does it mean? It means that, let me give you an example. For example, you have visited the client, you went there for the audit. There, your senior asked you to audit property, plant, and equipment. And while auditing property, plant, equipment, you are required to check the depreciation expense. So, what did you do? You go to the client and you took fixed asset register of their, you got their fixed asset register along with their depreciation policy. Tell me, considering that, let's say client had recorded depreciation expense of 7 million in their books. And when you took their fixed asset register, their depreciation policy, you recalculated, you reperformed the depreciation expense, considering, suppose that there was no error, you calculated it correctly, and it is coming out to be 7 million exactly. In this situation, even now, tell me, can you give guarantee or 100% assurance on property, plant, equipment, or on depreciation expense that this is correct? No, you cannot. Why? Because Guys, see, the recalculation that you have performed is again on the information that is provided by the management. The fixed asset register and depreciation policy is both of them provided by the management. So basically, you are doing your procedures on the information that is provided by the management. Okay, so we already doubt the management. So if they want, they can change the data that they are providing you so that you performed recalculation and then the answer is exact same what they have recorded. So idea is the level of evidence can never be conclusive in double A, can never be conclusive in audit. Okay, for an auditor, it will always be persuasive, right? So this is why we cannot give guarantee. In audit, we cannot give absolute or 100% assurance. The fifth very important limitation due to which we cannot provide guarantees basically limitations of internal control. So let's say the client, there's a big listed entity for which we are performing audit of a big listed entity, and there are many sophisticated internal controls. Even then, there is limitation of those sophisticated internal controls. So basically, what are internal controls? It could be your segregation of duties, it could be reconciliations, it could be authorization, okay, it could be passwords, physical controls, etc. So basically, these controls are policies and procedures applied by the management. Why? They want to detect, correct errors and frauds on timely basis. So even they tell you that there are very strong sophisticated internal controls, so there is very less chance of errors or frauds in the entity. Please remember that even the perfect internal controls, even the perfect sophisticated internal controls have their limitation. Why? Because they are made by the human beings, they are made by the management. So even if they are perfect, still the management is able to override those internal controls. They can circumvent those internal controls. So let's say if they tell you there is segregation of duty control, let's say for the transaction over 7 million or for the payment over 7 million, there are two signatories, CFO and CEO, who will sign the check and then the payment will proceed. So now, if they want to circumvent this control, I have to think with the questioning mind. Okay, so I'll think that, let's say, what if CEO and CFO both decides to approve 8 million voucher, 8 million cash payment, and they divide between them equally, 4 million for CFO and 4 million for CEO. No one is there to to stop them. So there is always an inherent limitation of internal control. They cannot be perfect. Okay, they, because they can be override, they can be circumvent from anyone in the organization. Because of these limitations, because of sampling, materiality, subjectivity, your evidence persuasiveness, not conclusiveness, and your limitations of internal control, all of these make you think that, okay, we cannot provide 100% assurance, we cannot give guarantee, rather we can only give the reasonable assurance, which is the highest level of assurance. This is it, guys. Thank you so much. See you in the next session.